We would now like to invite Mr. Subramaniam to share with us the enormous scope that the equity market has for us, rather than the vanilla products in the equity markets has for us, rather than straight away going for the alternative investment opportunities.
Good afternoon, everybody. I'm going to keep it very short and simple. So I just have 4 slides to run you through. So don't worry, I'm not going to go on for very long. And in fact, even out of those 4 slides, one really doesn't count as a slide. So it's going to be very snappy in terms of the thoughts that I wanted to share with you today. And I think Chokalingam just made the point about foreign investments. And in fact, he set me up very well for that, because really the focus that I wanted to bring was not so much on what foreigners do, but really focus on the fact that I think the market place and our focus needs to be in terms of serving the needs of the domestic investor, because that is really the rapidly growing pool of savings, and we need to find a way to channelize this into productive investments. We need to channelize the Indian investor more and more away from physical savings and more towards financial savings, because this is part and parcel of what really keeps the growth of an economy on track. And this is what is really required for us to meet those aspirational goals that we have of growing at 9% or even double digits for an extended period of time in the near future. The beauty of technology is that it has democratized everything, and I think it has also democratized the business of forecasting, because now all you need is an Excel sheet in which you can plug in some numbers, and you can pretty much forecast what numbers will look like all the way out into 2010, 2020, 2030. And we've got a classic example here of what the Indian economy might look like in terms of size and scale by 2025, which is, let's say, approximately 14 or 15 years from here. And the context that I really wanted to bring to the equation over here today is to say that given what we know, and this is very likely to be an outcome, the Indian economy in size will grow to almost about $7 trillion by that point of time. And the challenge for us is going to be, how do we empower the Indian investor in helping him make an investment for his future, and how do we direct those savings? Now, what you have over here are obviously forecasts which are based on historical patterns that we know. But the numbers are stupendous, because what this data is really telling you is that the cumulative savings pool that needs to get deployed over this period could be as much as $10 trillion. So this is a very large amount, and there are many of us in the investment business and different parts of it. You can call it what you want. You can call it pension funds, you can call it insurance, you can call it the new pension scheme, you can call it mutual funds, but essentially all of us are in that investment management space and trying to sell customers the products that they need and they would require to channelize these investments. So the size and scale of the opportunity in that sense is really tremendous, and that is why you see a lot of excitement in the financial sector. There's been a lot of capital deployed by companies to try and tap into this opportunity. The point that I would again highlight over here is these are all forecasts in terms of where that money might go. Bank deposits have typically been the mainstay of Indian savings. Almost about 40% of the savings pool goes into bank deposits. Some of these patterns will change, and one of the reasons these patterns will change is essentially got to do with what is on this next slide, which is again demographics. Now demographics again is a very, it can be abused in terms of the outcomes that you want to project with it. And when you do a SWOT analysis for India, as much as you would put demographics in the strengths column, I would also put it in the threat column, because you've got this large population which needs to get educated, which needs to find productive employment, and if you're not able to do that, you've got a revolution on your hands. And we got a small inkling of how that feels not so long ago. So demographics plays to our strengths at this point of time. simply because as we go ahead over the next few years, the percentage of working population as a percentage of our total is going to go up quite dramatically, and therefore the size of the savings pool itself will actually grow much faster than underlying GDP growth. So this demographic is really one of our key strengths in that sense, and I think this is something that will play out over a period of time, and the pool of savings is likely to multiply, driven by this parameter alone. Now the third slide, and this is the one that I want to spend a little bit of time on, because this is what it really builds up to, which is my sort of primary area of focus, which is really the equities market. If you look at the numbers in terms of the historical pattern of what Indians have invested into equities, we have gone as high as 9 to 10% of the entire pool in years like 2008, and in bad years it has gone down to about 4% of that total savings pool that the households have. So it is a fairly significant number which starts to build up over time. Almost $1.1 trillion over this 15-year period is the potential investments by Indian households into equity. This is not something which is going to happen by default. You need to, again, as I keep repeating, create the right products, create the vehicles through which this money will go. It needs to be attractive to the consumer in terms of the cost of the experience as well as the kind of experience that he has. And this is, I just take an example here from the cell phone industry. The cell phones were around in India right from 94, 95 is what I recollect. But at that point of time, it was a luxury, right? It was 32 rupees a minute for both incoming and outgoing calls, right? So that is why in India we have created still this wonderful concept called a missed call. I guarantee you, you go anywhere outside this country and tell somebody give me a missed call, and he will look at you very blankly because he doesn't understand what it means. But that was created for a reason. It was created because a call cost you 32 rupees. So it was a wonderful piece of innovation, very Indian in nature. But the real explosion in the cell phone base happened not when it was 32 rupees a minute, but when it came down to 1 rupee a minute. And that is equally the challenge facing all of us in the investment management space, which is how do we create products at the right price point for the investor. And there's obviously a lot of regulator focus on this as well. I think the regulators have pushed us along this path as well, and that is, I think, very welcome for the long-term development of the industry. But we need to be able to figure out how we can tap this $1.1 trillion of opportunity which is there over the next 15 years or so, and channelize it. And it doesn't matter, as I keep saying, which vehicle it comes through, whether it is pension funds, insurance, whether it is mutual funds. These are all just names. The purpose of this is really to get it into the productive space and get the investment cycle kicking. Now, very often this chart is misused, and it's misused for the line which is at the bottom, which says that the cumulative savings pool in India is equal to 90% of total Indian market cap. Now, for heaven's sake, don't use this chart as a reason to go out and buy stocks. Because keep in mind that at the end of the day, these economic identities operate together, and one is really the outcome of the other. In fact, I would say it's essentially a symbiotic relationship. To put it in context, if you need to grow your GDP at about 7 to 8%, you need to have an investment rate of close to about 25 to 30%, because I'm sure all of you know, our incremental capital output ratio runs at something like about 4 odd times. So you need to have that kind of a investment rate. So when we talk about household savings of 1.1 trillion equal to almost 90% of current market cap, this is not necessarily an argument for a bull market, because keep in mind, if you just look at a shorter time frame, the Planning Commission estimates that we will invest close to $1 trillion in infrastructure during the next plan period, which is 2013 to 2017. If you are going to fund $1 trillion of investments, where is that money going to come from? Okay, you take a very simple thumb rule, 70% of it will come from debt financing, 30% of it will come from equity financing, right? So you need $300 billion of equity which needs to be mobilized to actually achieve those investments and then get us the growth. So you effectively need $150 billion, presuming that, half the equity requirements comes from internal accruals that companies make, and the rest of it comes from investors who lend their household savings, not lend, but rather invest their household savings into equities. So you need $150 billion just to come from household savings to balance out the entire equation. So this is a very often misused chart in terms of using this as the basis for forecasting a bull market. I won't do that. But what I want to say is that the size of the opportunity is tremendous. To my mind, as a businessman, the challenge is not so much what will this $1.1 trillion do to overall market cap. The challenge is how can I build a business model which will tap into this $1.1 trillion and give people the investment products that they want. And I think at some level, all the speakers that you heard today are trying to do the same, whether it's hedge funds, whether it's private equity funds, whether it's just wealth management, whether it is the mutual fund industry which I represent. So all of us need to figure out which are those products which can actually tap into this opportunity and then allow the money to flow in. And again, I keep coming back that these are all really identities. Each of these numbers is dependent on the other. If you don't get a high savings rate, you will not get a high investment rate. You will not get the 8 or 9% GDP growth that you aspire to, which means you will not get the savings that you aspire to in the first place. So these numbers are continuously in balance, and we need to create the soft infra mechanisms through which money can get moved into the markets and into productive investments. Now, I spend a lot of time answering people who, are forever focused on this issue of foreign money in our stock markets, and, some for completely valid nationalistic reasons would like our markets to be driven more by domestic investors. Some maybe have more noble intentions that they want Indians to participate in the process of wealth creation, which is also a very good objective, because actually what has happened in India is that direct ownership of equities by the Indian public has actually come down over the last 20 years that I've been in the stock market. It's actually come down from 25% of total market cap to today less than 10%. Direct, obviously they've increased their indirect ownership of the stock market through mutual funds and insurance. But the point remains that everybody feels the need for what they call a countervailing force to the impact of global capital flows. At some level, I'm of the opinion that today we are all interconnected. Your economies are interconnected, your financial markets are interconnected, and therefore you can't fight this beyond a point, and we have to accept it. Globalization and democratization of technology has added great value to us as a nation, and don't expect that you can suddenly, throw the baby out, because I think that's going to be dangerous. But we also need to recognize that the same battle that we are, constantly worried about creating the so-called countervailing phase, force to foreign investments, has actually already come about. And I don't know why anybody doesn't check the math, but this is the actual math for 2004 to 2011, which is that if you take the domestic institutional investors as a combined category, so you've got insurance companies, you've got LIC, and you've got the mutual funds, all of them put together have pumped in $55 billion over this 7-year period into equities, which actually compares very well to what foreigners pumped in during this period, which is actually $68 billion. And mind you, I'm not taking into account the money that the domestic investor has pumped in directly into equities, which frankly will, if I add it to this, it will take it well above $68 billion. So the point really is that I think we need to realize that the domestic investor today is a potent force, and through whatever means he comes, whether it is directly, whether it is through mutual funds, whether it is through insurance, whether it is through the NPS system, he is already a force to reckon with. This is a force which will keep growing because of the secular nature of our growth. And I think we are not very far away from the years where increasingly our focus will be on what is the domestic investor doing with his money to sort of understand what might happen in the stock markets, rather than focusing unnecessarily on the foreign investor. And this is a transition which is already visible in many places. This is one way of looking at this number. Another way of looking at this number is what is the ownership of Indians through existing institutional mechanisms in the stock market as compared to foreign holdings in the stock market. Today, foreigners hold about 18% of the market cap of the BSE 200 index, which is about 85-90% of the stock market. Indian institutions own close to 16%. So the gap is only about 2% odd. If you add in the local investors, then we are already in excess of what foreign investors hold. If you look at it another way, look at the Nifty index. 22 companies in the Nifty index have domestic institutional holdings of more than what foreign institutional investors hold. So, just to again sum it up, I think the transition to becoming a stock market which is driven by Indian investors is already happening. The outcome of what happens in terms of returns in the stock market is a function of how our companies do, how our economies do, and what kind of earnings they generate. And eventually, as Chokalingam keeps pointing out, also that P number, which is an unknowable, which affects the valuation that equities trade at.